Are you tired of wondering whether you're making the right investment decisions? Do you want to maximize your returns and achieve long term financial success? Well, you've come to the right place. Today, we'll unravel the mysteries behind the optimal order for investments, providing you with a step by step, comprehensive guide to financial success. I'm Justin Saffel, an investment advisor with more than 13 years investing experience in the financial markets. Join me as we explore the strategies, tips, and insights that the top investment advisors use to navigate this complex world of investing. Whether you're a beginner looking to build a solid foundation or an experienced investor seeking to refine your approach, this video is for you. Let's dive in. Okay, step one, paying off high interest consumer debt. The reason this is number one on my list is because of how insidious consumer debt is. High interest consumer debt is so bad because of what I call reverse compounding. Here's what I mean. Warren Buffett made his $85 billion fortune by compounding gains. His average annual gain since he started at age 10 is 22%. Turns out the average credit card interest rate is also around 22%. The only difference is that instead of earning money, you're paying it, and your wealth compounds negatively. Ever see the credit card statements where it tells you what happens if you only pay the minimum? Well, that's reverse compounding in action. Consumer debt and reverse compounding is what I call anti-wealth. Paying off high-interest debt before investing is crucial because it helps you save money in the long run. By eliminating high-interest debt, you can reduce the amount of interest you pay over time and free up more funds to invest. It can also help your financial health and credit score, making it easier to access better investments in the future. Here are a couple of strategies that I personally use to get out of debt fast. First, the momentum method. The momentum method is a strategy for paying off debt that focuses on tackling small debts with high interest rates first. Here's how it works. First, start by paying off debt with the smallest balance and the highest interest rate. Then, make payments on your other debts. Once you've paid off the smallest debt, move on to the next smallest debt and continue the process. The momentum method helps you gain motivation as you see the smaller debts disappear. It can also provide a sense of accomplishment and keep you motivated to pay off larger debts. As you pay off each debt, use the money you're putting towards the debt to make larger payments on the next one. Over time, your payments start to gain momentum, and you make faster progress towards becoming debt-free. The next method is what I call the BYOB method. And no, I'm not talking about a backyard party where you bring your own beverage. The BYOB method is be your own bank method. If you have a 401k balance, then you can actually be your own bank by borrowing from your 401k to pay off your debt. Here's how it works. Using your 401k balance, you may be able to take a loan from it. By borrowing from your own retirement savings, you can access the funds you need to pay off the high interest debts. And you pay yourself back plus interest. Just keep in mind that there are some risks involved, such as penalties if you're unable to repay the loan within a certain time frame. Remember, managing and reducing debt can feel overwhelming. Be sure to celebrate the small victories along the way and stay committed to your repayment plan. Okay, moving on to step 2 in our financial journey, establishing financial goals. Setting clear financial goals is crucial for guiding investment decisions. Think of your goals as a roadmap to your desired financial destination. Just as Google Maps won't give you directions without a destination, it's hard to know where you're going financially without clearly defined goals. They help you prioritize spending and make more informed investment choices. Clear goals can also provide motivation, keeping you focused and disciplined. Plus, they allow you to measure progress and celebrate milestones along the way. To help identify and prioritize some of these financial objectives, it's important to start by reflecting on your own values and what really matters to you. Consider what you want to achieve in the short term, but also in the long term, such as having a savings for retirement, buying a house, or maybe even starting a business. Next, Assess your current financial situation by analyzing your income, expenses, and existing assets. This will give you a clear understanding of where you stand and what areas may need improvement. Setting SMART goals is crucial. Make them specific, measurable, achievable, relevant, and time bound. Break down larger goals into smaller, actionable steps to make them more attainable. Okay, moving on to step 3, building an emergency fund. I can't stress enough how important it is to have an emergency fund. Seriously, it's like having a safety net for your investments. Life is full of unexpected surprises, right? Your car breaks down, you have a medical emergency, or maybe you lose your job. Having an emergency fund means you've got some cash stashed away specifically for these kinds of situations. It gives you peace of mind in knowing that you're financially prepared for whatever curveballs life throws your way. Plus, having that cushion helps protect your investments. Instead of having to sell off your stocks or dip into your retirement savings when an unexpected expense pops up, you can use your emergency fund. It's like having your own personal financial superhero. So start squirreling away some money into that emergency fund. When it comes to building an emergency fund, a general rule of thumb is to aim for at least 3 to 6 months worth of living expenses. Now, this amount can vary depending on factors like income stability and financial obligations. Personally, I only keep about a month of emergency savings. However, if you have a higher risk of job loss or irregular income, it's a good idea to save a little more. It's also a good idea to keep your emergency fund in a separate savings account that's easily accessible. Look for accounts that offer competitive interest rates, like a high-yield savings account. In 2023, some of them pay as much as 5.7% interest. Remember, unexpected expenses can occur at any time, so regularly review and adjust your emergency fund as needed. If you dip into it unexpected, make it a priority to replenish it as soon as possible. By staying committed to building and maintaining your emergency fund, you'll have a peace of mind of knowing that you're prepared for whatever comes. Okay, next on our financial journey is step 4, maximizing your retirement contributions. First things first, let's talk about the 401k. It's a retirement account offered by your employer, and if they offer a match, it's like free money. You should definitely contribute up to the match because you're getting a 100% return on that money. For every dollar you put in, your employer adds a dollar. It's an incredible opportunity to boost your retirement savings. After you've contributed up to the match, though, you should probably move on to other investment vehicles. Investing in a Roth IRA after a 401k is a pretty smart move, so let's break it down. The Roth IRA is another retirement account, but with a different approach. With a Roth IRA, you contribute after-tax dollars, which means that you've already paid taxes on the money you put in. The beauty of the Roth IRA is that earnings grow tax-free, and when you withdraw the money in retirement, it's also tax-free. That's right, tax-free growth and tax-free withdrawals. By investing in a Roth IRA after you've maxed out your 401k contributions, you're diversifying your retirement savings. Having both pre-tax and after-tax retirement accounts gives you the flexibility when it comes to managing your taxes in retirement. Another advantage of the Roth IRA is no required minimum distributions. With a traditional retirement account like a 401k or a traditional IRA, you're required to start taking withdrawals once you reach a certain age. But with the Roth IRA, you have more control over when and how you withdraw your money. In 2023, the contribution limits for a Roth IRA are $6,500 with an additional $1,000 catch-up contribution allowance for people over 50. You should max out your Roth contributions before moving on to other investment vehicles like a traditional IRA. Before we head into that, if you're wondering just how much money you should be saving and investing for retirement, then consider using my critical mass index calculator to find out. It's an unorthodox method for determining how much you should be saving. I have a link down in the description below, so go check it out. Moving on to the traditional IRA. After maxing out your Roth IRA contributions, investing in a traditional IRA can be a smart move for several reasons. First of all, a traditional IRA allows you to contribute pre-tax dollars. This means that the money you contribute to your traditional IRA is deducted from your taxable income, potentially reducing your current tax liability. It's like getting an immediate tax break. Another advantage of a traditional IRA is greater investment flexibility compared to a 401k. With a 401k, you typically have a limited selection of investment options chosen by your employer. But with the traditional IRA, you have more control over those investment choices. While contributions to a traditional IRA are tax deductible, it's important to know that the earnings in the account grow tax deferred. This means that you won't pay taxes on investment gains until you withdraw the money in retirement. By deferring taxes on your earnings, you have the potential for greater compound growth over time. However, it's essential to consider that in retirement, the earnings in a traditional IRA are subject to taxation upon withdrawal. This is an important factor to keep in mind when planning your retirement income and managing your tax obligations. Now, if you're self-employed or own a business, investing in a SEP IRA can be a smart move, and here's why. First, there are some tax advantages. SEP IRA contributions are tax deductible, reducing your taxable income and potentially lowering your tax bill. Second, higher contribution limits. SEP IRAs allow for higher contributions, up to 25% of your net self-employment income. If you've made it this far, then you're well on your way to financial freedom and living the life of your dreams. However, opening and contributing to a retirement savings is just the first step. You also need to invest and then diversify your investments a little bit. This doesn't have to be hard though. Here's my super simple strategy. All right, step 5, diversifying your investments. Diversification is a key strategy that will help you reduce risk and increase your chances of achieving long-term goals. You wouldn't want to put all your eggs in one basket, right? Wrong. In my opinion, diversification is really just a hedge for ignorance. Beyond a certain point, spreading your investments across different asset classes, like stocks, bonds, real estate, and maybe even small businesses, will only hurt your performance and really not help it. Because if one of them is doing well and the other is doing bad, then it will only dilute your performance. And what happens if they're all doing bad, like during the 2008 financial crisis? Legendary billionaire investor William O'Neill, who was the founder of Investors Business Daily and the author of several best-selling books like How to Make Money in Stocks, says it's okay to put all your eggs in one basket if you watch the basket really closely. Now, William O'Neill was an expert who specialized in buying and selling growth stocks, so it made sense for him to concentrate on individual stocks. However, most of us are not growth stock traders, so it may make sense for us to diversify some. My recommendation for retirement funds is to invest in a low-cost index fund that matches the performance of the S&P 500 or the NASDAQ. Low-cost index funds are a smart way to diversify investments and reduce risk. They track specific market indexes like the S&P 500, and they aim to match their performance. The cool thing is, by investing in these funds, you're spreading your money across different companies or assets. Plus, they have lower fees compared to other funds and historically show consistent returns. Okay, once you're happy with your retirement plan, it's time to explore other investment options. On to step 6 of our journey. If you want to be truly financially free, then you're going to have to find ways to make more money. Your W-2 income is simply not going to be enough. My recommendation is that you find an investment option that really interests you and become an expert in it. The best way to grow your wealth is to concentrate in assets that you have a deep knowledge of. Consider investing in individual stocks, for instance, but be cautious and do your research. Look for strong companies with a competitive edge. If this interests you, then a good place to start is with growth stock investing. I highly recommend reading How to Make Money in Stocks by William O'Neill. I'll link to it in below. Now, real estate can also be a lucrative choice, offering passive income and potential appreciation. Think about rental properties, commercial properties, or real estate investment trusts. Finally, starting a small business is another exciting opportunity. But be prepared for hard work and risks. Research the industry, evaluate market demand, and develop a smart business plan. Cody Sanchez is an excellent resource for learning how to buy existing businesses for baby boomers looking to retire. Check out the link below to her YouTube channel. Are you interested in more financial tips? Consider watching one of my other videos or subscribing to my weekly newsletter. That's all for now. I'll see you soon.